I recently spoke with someone who is interested in a whole life insurance policy, and they asked, can the policy pay for its own premium without becoming worthless? Meaning, can I stop making payments and not have the policy eat the cash value alive and see things go down to zero? Which there are a lot of horror stories out there about exactly that happening to cash value life insurance policies. The answer to her question was yes. That's very easy to do. There are two options available. The first option that you have available is called a premium offset. A premium offset allows the policy's dividends and interest to support the premium for you. With this option, you will not see the death benefit suddenly drop. In some cases, you'll see it gradually go down. In other cases, you'll see it continue to go up. A big benefit to this option is if in the future you want to resume premium payments, you can do so. This can be a temporary and in some cases a permanent option. Another option that's available is called a reduced paid up option, or RPU. I like to call this the kill switch. Why I call it the kill switch is because this option eliminates the premium altogether. My dividends and interest don't support my premium. Instead, they're kicked back to cash value. Now, a drawback to this is that I cannot resume premium payments, and in many cases, I'll see a sudden drop in the death benefit as well. However, the cash value growth can be very attractive. Now, I'll also add that this scenario or this option works beautifully with short pay scenarios, which means someone comes in with a lump sum of money and they say, I want to move money into this life insurance policy quickly, and I don't want to be on the hook for ongoing premium payments. They might move a couple $100,000 into a policy over 2 or 3 years and stop altogether. I'd actually use a combination of a premium offset and reduced paid up option, but a reduced paid up works really, really good there. So what I would do here is look at a comparison. Let's do exactly that. We'll compare the same insurance company, the same insurance product, and the exact same out-of-pocket, but we'll see what the numbers look like with a premium offset compared to a reduced paid-up option. First, we'll look at the non-guaranteed values, then the guaranteed values, and then we'll look at that short pay scenario I mentioned. So to kick things off, let's take a look at our premium offset. So we've got a 40-year-old individual who is funding $20,000 per year. Now we can see where his money is going. You've got $2,500 going toward the minimum premium. This includes the base premium plus the cost of the term insurance rider, and then everything else is added to the paid up additions rider, which accelerates the cash value growth. So the net out of pocket is $20K per year. We can see the total funding, cash value, and death benefit. What's highlighted in yellow represents the break-even point. By the 4th year, he's paid in $80,000 and he has more than $80,000 in cash value. Now, he funds the policy for 10 years in this example. After the 10th year, what do you notice about his annual funding? It's zero, meaning he pays nothing forever. To the left, though, you'll see that the minimum premium is still due. So in this particular illustration, the dividends and interest are covering that $2,500 premium for him every year. Now the cash value still increases at an attractive rate as well, I'll add, but I would also argue that you do have some drag with this particular policy, because if your intention is to never make another premium payment, the policy supporting that premium can slow down the growth a bit. Why I say that is because if we compare that to a reduced paid up option, you'll see more cash value. So I'll hit on that, but first I just want to go through exactly what this reduced paid up option does. So it's the exact same policy. You'll notice that the cash value and death benefit are identical in both options through the 10th year. But in the 11th year, you no longer have a premium with this option, we exercised that reduced paid up option. Two things happen here. One, the premium's gone. You forfeit the right to pay anything into this policy regarding premium or PUAs. You can still borrow and repay, but we can no longer add money. The second thing that happens is your death benefit drops as a result. So those are two drawbacks or disadvantages. The advantage, however, is because I no longer have a premium due, well now, all of my dividends and interest, guess what, can flow back to the policy, and look at what happens. So we've got both the cash value and death benefit difference. This is showing how much more or less you have in cash value with the reduced paid up option after the 10th year compared to the premium offset option. At first, not that much, but as time passes, that gap does widen. And this is based on the non-guaranteed values. Let's take a look at the guaranteed values. So, starting with the premium offset option, you've got the exact same thing. Worst case scenario, looking at the guarantees though. Here's your reduced paid up option. There's your difference. It's a bit more amplified when we look at the guarantees. Now, one thing I will add about this is you don't have to choose which option you're going to do up front. This is an after the fact change. And I'll demonstrate that with the short pay scenario. So going back to the non-guaranteed values, here's our scenario where we funded it with $20K per year for 10 years and then exercised a reduced paid up after 10 years. Let's pretend that this is you and you said, hey, I like this, but I've got the 200 grand sitting in cash right now. Can I move it into the policy faster than 10 years? Like, I don't want to wait that long. That's a long time for it to be sitting in cash. I'm going to use it for other things in the meantime. Well, the answer is yes. Here's what I would do if you're 40. So here's the exact same product, but what do you notice? Here's your annual funding. First year, we plowed 100 grand in. Your minimum premium is 5,000. The other 95,000 went to PUAs. First year cash value, 92.5. The death benefit's so high at 2 million and change because we need it high to prevent a MEC. If you don't know what a MEC is, it's a taxable event. This policy has a MEC limit of 100K, so we can still access the cash value tax-free. We're following IRS rules. The break-even point is year 3. So what this short pay is doing for us is we moved money into the policy over 3 years, and then we paid nothing. What we did here is we exercised that premium offset years 4 through 7, and then in the 8th year, we exercised that reduced paid up option. Why we waited until year 8 is because that's the earliest we can exercise that reduced paid up option without triggering a modified endowment contract or a MEC, a taxable event. But this is a nice combination of a premium offset plus a reduced paid up option in order to absolutely juice the cash value as much as we can in a scenario where we want to fund a policy with a lump sum. So back to her original question, can the policy pay its own premium without becoming worthless or eating itself alive? Yes, it's very simple to do, especially if you prioritize cash value growth up front. But the question really is, as the years pass, do you have an intention to make premium payments again? Because if you don't, that's where I would definitely look at that reduced paid up option. And if I'm in a situation where I've got a ton of cash and I want to fund the policy quickly, that's where I would compare, call it a 10-year funding scenario, whatever I'm originally shown, with an option where I move the money in quickly and specifically see if it gives you more value, like what you see here. Anyway, I hope you enjoyed this video. Please let us know your thoughts in the comments below. And as always, I hope this helps.